Most traders believe the difference between consistent profitability and constant frustration lies in strategies or indicators. The deeper truth is psychological. Consistent traders develop a mind trained to think in probabilities rather than outcomes. The market does not reward intelligence alone, it rewards emotional neutrality. The moment a trader understands that consistency begins in the mind, not in the chart, the real transformation begins. The human mind was never designed for trading. It evolved to protect you from danger, pain, and uncertainty. In everyday life, this protection is useful, but in the markets, it often becomes sabotage. The same instincts that keep you safe in the physical world push you to avoid losses, close trades too early, or chase certainty. What protects you in life can quietly destroy your consistency in trading. The brain reacts emotionally before logic has time to intervene. When a trade moves against you, the emotional system interprets the situation as a threat. Even though there is no real danger, the body reacts with stress and urgency. The mind seeks escape from discomfort, and that impulse leads to impulsive decisions. Instead of following the trading plan, the trader begins reacting to feelings rather than probabilities. Every red candle can trigger the same survival response that once protected humans from predators. The body tightens, the mind rushes, and the trader acts quickly to remove discomfort. Positions are closed too early, losses are avoided emotionally rather than managed strategically, and profits are cut short. The market becomes a battlefield of emotions instead of a structured environment of statistical opportunity. A professional trader learns to operate in a way that feels unnatural to the human mind. The ordinary mind seeks certainty and comfort. The trained trader learns to operate calmly inside uncertainty. Discipline replaces impulse. The trading plan becomes the anchor that guides every action. Instead of reacting to every fluctuation, the trader remains stable and executes the process with consistency. Success in trading does not come from collecting more indicators or constantly searching for new strategies. It comes from retraining the mind to stop interfering with the edge that already exists in the system. The trader's task is not to eliminate uncertainty, but to accept it. Once uncertainty is accepted, the focus shifts from prediction to execution. There is a powerful paradox in trading psychology. In normal life, avoiding pain is considered intelligent behavior. In trading, the ability to calmly accept temporary discomfort is a form of wisdom. Losses are not personal failures, they are part of the statistical process. The trader who understands this no longer fights the market or his own emotions. The journey toward a probabilistic mindset begins with awareness. Most traders react automatically without realizing it. They exit trades before the stop loss simply because they cannot tolerate seeing negative numbers. Others enter trades impulsively because they feel the market is about to move, even when the trading plan says otherwise. These behaviors are not strategic decisions, but emotional reactions. A probabilistic trader is not concerned with being right on every trade. The focus shifts toward executing the trading plan with precision. A trade can end in a loss and still represent perfect execution. In this mindset, success is measured by discipline rather than by the outcome of a single position. Each trade becomes only one data point in a larger statistical sequence. When a trader begins thinking in probabilities, the emotional intensity of individual trades decreases dramatically. The trade is no longer interpreted as a personal victory or defeat. Instead, it becomes one sample among many. The professional understands that an edge expresses itself only through repetition. Patience and consistency allow the probabilities to unfold over time. Developing this mindset requires the ability to pause between emotion and action. The emotional brain reacts instantly, but the disciplined trader creates space before responding. In that small pause lies the power of professional execution. Breathing, observing, and returning attention to the trading plan allows logic to regain control over impulsive reactions. A calm body supports a probabilistic mind. Extreme excitement and intense fear distort perception and decision-making. The professional trader cultivates emotional neutrality, a state where neither euphoria nor anxiety dominates behavior. From this neutral state, decisions become clear and consistent. The trader stops chasing validation and begins focusing on process. The ego wants to be right. It wants proof of intelligence and confirmation of control. A trained trader understands that the market does not reward ego. What matters is the ability to repeat correct actions consistently. Even when a trade ends in a loss, the disciplined trader values the quality of execution. The process becomes more important than the immediate result. Over time, the identity of the trader changes. Instead of acting like a gambler seeking excitement or validation, the trader becomes an executor of statistical advantage. The goal is not to predict every movement, but to consistently apply a proven edge. This shift in identity transforms decision-making and removes much of the emotional pressure that destroys performance. A powerful example of probabilistic thinking can be seen in the way a casino operates. The casino does not worry about the outcome of a single spin of the roulette wheel. It knows that some rounds will produce losses. What matters is the mathematical edge embedded in the system. Through repetition, the probabilities eventually produce consistent profit. Professional traders operate in a similar way. They do not chase the market or attempt to control every outcome. Instead, they execute their strategy with the calm discipline of a casino, applying its statistical advantage. Each trade is simply another repetition of the same process. The edge reveals itself through consistency, not through prediction. When a trader fully accepts that the market cannot be controlled, attention shifts toward the only element that can be controlled, the mind. Mastery in trading is not the ability to dominate the market, but the ability to regulate one's internal state while interacting with uncertainty. In that mastery lies the foundation of long-term consistency. A professional trader does not attempt to predict the next market movement. The focus is on executing a proven edge repeatedly. Just as a casino relies on probability over hundreds of spins, the trader relies on disciplined repetition of a statistical advantage. The outcome of a single trade becomes irrelevant. What matters is maintaining the integrity of the process long enough for the probabilities to reveal their natural outcome. The novice trader behaves very differently. Instead of executing a defined process, he approaches the market like a gambler. Trades are entered without a clear plan, without validated strategy, and without defined risk or exit. When two trades win, confidence explodes. When a single loss appears, frustration and doubt take over. Because there is no structured edge, every result feels personal and chaotic. The professional trader never approaches the market as a game of chance. Like a casino owner, every variable is measured and defined before the trade begins. Entry, position size, risk tolerance, and profit targets are all predetermined. Nothing is left to emotional impulse. The difference between the losing trader and the consistent one is not luck but mindset. One reacts emotionally, the other executes a structured advantage. Consistency is not created by perfection but by disciplined repetition. A trader does not need every trade to succeed. What matters is applying the same edge again and again without interference from fear or excitement. The trader who learns to operate through probabilities eventually develops stability in results. The one who trades based on intuition remains trapped in the emotional cycle of gambling. Consider a situation where you enter a trade and the market begins moving against you. Your trading plan clearly defines the stop loss, but the emotional brain interprets the temporary loss as danger. Anxiety rises, and the impulse to escape discomfort becomes strong. Instead of allowing the trade to reach its logical stop, you close the position early to relieve the emotional pressure. When the market later reaches the area where your stop loss was placed, you feel temporary relief. You tell yourself that you avoided a full loss. In reality, the mind has created an illusion of safety. The trading plan was abandoned, and the statistical structure of the strategy was interrupted. What appears to be a smart decision is actually emotional interference disguised as risk control. On the following day, a similar setup appears, and you enter again. Once more, the price moves slightly against you. Remembering the previous discomfort, you decide to adjust the stop loss to avoid another loss. The market quickly touches the new stop and removes you from the position. Moments later, the price reverses and moves directly toward the original target. Now the damage becomes visible. Instead of one controlled loss and one full winner, you have created two unnecessary losses. The strategy itself may still have a positive edge, but your emotional reactions have distorted its statistical outcome. This is how a good system becomes unprofitable. The problem is not the strategy, but the inability to execute it consistently. The ordinary human mind seeks immediate safety. It tries to minimize pain by escaping uncomfortable situations as quickly as possible. This instinct leads traders to close losing trades prematurely or take profits too early because they cannot tolerate temporary pullbacks. The mind wants certainty and emotional relief, even when that relief damages the long-term expectancy of the strategy. Fear can also lead traders to ignore stop losses entirely. Instead of accepting a controlled loss, they move the stop further away or add more positions to recover what was lost. In these moments, the emotional brain is shouting for action. The trading plan demands patience and discipline, but the survival instinct pushes the trader toward impulsive decisions. In everyday life, avoiding pain is logical and often necessary. If something harms you, the natural response is to avoid repeating that experience. Trading operates under a completely different psychological structure. A losing trade does not mean the strategy is wrong. It simply represents one outcome within a statistical distribution that requires repetition to become meaningful. This contradiction between natural instinct and professional execution destroys many traders. Each loss activates the mind's protective mechanisms, creating emotional noise that interferes with clear decision-making. Instead of following the system, the trader begins adjusting entries, exits, and risk parameters based on feelings. The more adjustments occur, the further the trader moves from consistency. Many traders actually possess strong strategies, well-defined setups, and solid technical analysis. The failure rarely comes from lack of knowledge. The real weakness lies in the inability to tolerate emotional discomfort while following the plan. When the mind cannot remain stable under uncertainty, even the best strategy becomes ineffective through inconsistent execution. The trader who eventually achieves consistency is not necessarily the most intelligent or the fastest thinker. The difference lies in psychological training. This trader learns to think in probabilities and accepts emotional discomfort as part of the process. Losses are not interpreted as personal failures, but as natural elements within a larger statistical structure. Professional poker players operate with a similar philosophy. They know that even when playing with a mathematical advantage, short-term losses are inevitable. What separates professionals from amateurs is the ability to continue executing the correct decisions despite temporary negative outcomes. Over time, the advantage expresses itself through disciplined repetition. A probabilistic mindset does not seek validation from being right. Its objective is consistency in decision-making. Each trade becomes an opportunity to apply the edge once more, independent of previous results. Emotional urgency disappears and is replaced by calm confidence. The trader stops fighting the market and begins cooperating with the natural rhythm of probability. Every time a trader reacts impulsively to protect emotional comfort, the process is disrupted. Every time the trader remains calm and follows the plan, the edge is reinforced. Growth in trading is not sudden or magical. It emerges gradually from the repeated practice of emotional discipline, where the trader learns to remain stable even when uncertainty creates discomfort. Training the mind begins with breaking automatic reactions. If you repeat the same emotional responses, you will inevitably repeat the same trading results. After a losing trade, the correct question is not why the market moved against you. The important question is whether the trade was executed according to the plan and the rules of the strategy. If the plan was followed correctly, the trader has already succeeded regardless of the outcome. A probabilistic mindset evaluates the quality of decisions rather than the immediate result. A loss that follows the rules represents professional execution. A winning trade achieved through impulsive decisions represents poor discipline disguised as success. A useful analogy can be seen in medicine. A doctor may follow every correct protocol and still lose a patient because uncertainty exists in complex systems. That outcome does not automatically mean the doctor made a wrong decision. The market functions in a similar way. The goal is not to control every result, but to act correctly within uncertainty. This is where the trading plan becomes essential. The plan transforms trading from emotional reaction into structured execution. It defines risk, entries, exits, and behavioral rules before emotions appear. When the trader commits to following this framework with discipline, the mind gradually shifts from gambling behavior toward professional probabilistic thinking. Without a trading plan, there is no objective judgment. Without judgment, there is no structured process, and without a process, consistency cannot exist. The emotional mind seeks validation from the market on every trade. The trained mind seeks only one thing: disciplined execution of the plan. Consistency emerges when the trader stops negotiating with emotions and starts committing fully to the structure of the trading process. Building this mindset begins with awareness rather than force. Small conscious adjustments create large psychological shifts over time. Before entering the market, pause and breathe. Notice the state of your body. If there is tension, urgency, or emotional pressure, you are not ready to trade. The breath becomes an anchor that reconnects the mind with presence, allowing decisions to emerge from clarity instead of emotional reaction. The body often reveals emotional imbalance before the mind recognizes it. Tightness in the chest, restlessness, or impulsive urgency are signals that fear or excitement is influencing decisions. A trader who learns to observe these signals develops a powerful internal compass. By listening to the body, it becomes easier to recognize whether decisions are coming from fear or from calm awareness. A trading journal becomes one of the most powerful tools for psychological growth. However, it should not only record numbers and outcomes. The deeper value lies in documenting thoughts, emotions, and reactions before, during, and after each trade. Over time, patterns become visible. These patterns reveal how emotional habits repeatedly interfere with disciplined execution. When emotional mistakes appear, the objective is not punishment, but understanding. Every impulsive decision reveals a hidden belief about risk, control, or failure. Observing these beliefs without judgment allows the trader to gradually transform them. Emotional errors are not evidence of weakness, but clues that reveal where psychological alignment still needs to be developed. Many traders struggle to accept small losses because they subconsciously associate losing with personal failure. The emotional mind interprets being wrong as a threat to identity. Yet in trading, being wrong is unavoidable. Losses are not evidence of incompetence, but natural components of probability. A trader who separates identity from individual outcomes gains psychological freedom. Euphoria can be just as dangerous as fear. After several winning trades, the emotional mind begins to feel invincible. Confidence slowly transforms into overconfidence, and discipline weakens. When the trader begins believing that losses are unlikely, risk management is ignored. The probabilistic mindset remains humble, understanding that every trade carries uncertainty regardless of recent results. Thinking in probabilities means understanding that short-term results do not define long-term outcomes. Winning 5 trades in a row does not guarantee the 6th will also succeed. Each trade is statistically independent. Because of this reality, the professional trader never abandons the trading plan during winning streaks or losing streaks. Discipline remains constant regardless of temporary results. The probabilistic mind approaches the market with humility. It understands that the market owes nothing to the trader. Profits are not demanded but accepted when conditions allow them to emerge. The trader stops trying to force outcomes and instead focuses on applying the process with patience and respect for uncertainty. Every time a trader enters and exits according to the trading plan, the correct behavior should be reinforced internally. Whether the trade ends as a win or a loss becomes secondary. The real victory lies in following the process. Repeating disciplined execution gradually retrains the brain to associate satisfaction with correct behavior rather than with random outcomes. A trained mind becomes the greatest advantage a trader can possess. Predicting the market is unnecessary when the trader can act clearly within uncertainty. The market environment will always remain unpredictable, but the trader's response does not have to be. Stability of mind allows consistent execution even when outcomes fluctuate. Human beings naturally search for certainty. They want guarantees, predictable outcomes, and confirmation that they are right. Trading offers none of these comforts. The market only presents probabilities. The emotional mind resists this reality and constantly searches for ways to eliminate uncertainty. The probabilistic mind accepts uncertainty as the natural environment of trading. The emotional mind wants to win every trade. It experiences losses as personal threats and becomes frustrated when the market does not cooperate. The probabilistic mind operates differently. It is focused on long-term outcomes. It accepts that multiple losses can occur in sequence without changing the validity of the strategy. Many traders fail not because they lack intelligence or knowledge, but because they misunderstand the nature of probability. They believe that if they analyze correctly and execute well, the market should reward them immediately. When the expected reward does not appear, frustration and doubt emerge. The emotional mind begins searching for a new strategy instead of improving execution. Imagine flipping a coin 100 times. The final result will likely approach 50 heads and 50 tails. Yet it is entirely possible for 10 tails to appear consecutively. A trader who understands probability expects such sequences and remains calm. The emotional trader interprets the same sequence as evidence that something is wrong. Because of this misunderstanding, many traders abandon profitable systems during normal losing streaks. They modify strategies, change risk parameters, or stop trading entirely. These reactions destroy the statistical foundation that produces long-term profitability. The probabilistic trader understands that consistency is measured across many trades, not through individual outcomes. The ordinary mind wants to be right immediately. The professional trader focuses on being right over a large sample of trades. 10 trades reveal very little about a strategy. 100 trades begin to reveal structure. Over many repetitions, the edge becomes visible. Patience allows the mathematical advantage to unfold naturally. This mindset does not appear automatically. It must be intentionally trained and reinforced. One simple principle captures its essence. The trader does not control outcomes, but controls execution. Repeating this principle consistently shifts attention away from prediction and toward disciplined action. Accepting this idea can be difficult because most areas of life reward direct control over results. In school, work, and relationships, the belief exists that doing everything correctly guarantees success. Trading does not follow this rule. A trader can execute perfectly and still experience losses because uncertainty is always present. The emotional mind interprets each loss as a personal threat. Anxiety increases and discipline weakens. The probabilistic mind interprets the same loss as a normal statistical event within the strategy. Nothing dramatic has happened. One trade simply represents the negative percentage of the system's expectancy. This perspective creates a profound difference in emotional stability. One trader operates with anxiety, constantly questioning the system and reacting impulsively. The other operates with calm discipline, following the plan even when outcomes fluctuate. Stability of mind protects the trader from self-sabotage during difficult periods. Changing results requires changing the way the mind interprets uncertainty. Without this transformation, the trader remains trapped in a cycle of frustration, impulsive decisions, and emotional exhaustion. Technical knowledge alone cannot break this cycle. Psychological alignment with probabilistic thinking is required. The probabilistic mind is not cold or indifferent. It is disciplined and aware. It understands that each trade is only one event within a larger sequence. There is no need to glorify a winning trade or dramatize a losing one. Emotional neutrality allows the trader to remain balanced regardless of short-term fluctuations. Professional poker players demonstrate this mindset clearly. They do not expect to win every hand. Instead, they understand when the odds are favorable, how much risk to take, and when to exit the game. Over time, their advantage expresses itself through disciplined decision-making rather than emotional reactions. Trading operates under the same principles. The trader's edge lies in the combination of method, risk management, and patience. Success does not depend on predicting the future, but on being prepared for multiple possible outcomes. When the mind accepts this reality, emotional pressure begins to disappear. The goal is not to build a perfect mind, but a trained one. A trained mind remains present rather than anxious, disciplined rather than reactive, and focused on process rather than obsessed with results. This internal stability allows the trader to navigate uncertainty with clarity and patience. Eventually, difficult moments will arrive, as they always do in trading. Losing streaks, unexpected volatility, and emotional pressure will test discipline. The trained mind does not collapse under these conditions. Instead, it pauses, breathes, observes, and returns attention to the trading plan. This ability to remain stable under pressure is what separates the consistent trader from the struggling one. The market will always challenge discipline, but the trader who has trained the mind to think in probabilities remains anchored in the process. From that stability, consistency gradually emerges. A disciplined trading mind is not something a person is born with. It is constructed step by step through deliberate practice and self-awareness. The transformation begins the moment a trader accepts responsibility for developing the psychological structure required to operate in uncertainty. Consistency does not appear suddenly. It grows from repeated commitment to process, emotional control, and probabilistic thinking. Every trader has the ability to build this mindset, but only those who commit to training their thinking will eventually experience stability in performance. One practical exercise is to write down the expected win rate of your strategy and keep it visible while trading. This simple reminder reinforces a critical truth: losses are part of the system. When a loss appears, it is not a surprise, but a normal expression of the statistical model. This awareness weakens the emotional reaction to negative trades and reinforces the idea that success is measured across a series of trades rather than by any single outcome. Another powerful exercise is to evaluate trades in groups rather than individually. Instead of judging every trade as a success or failure, review a block of 20 trades and analyze whether the plan was executed correctly in each one. This method trains the mind to think in probabilities. The focus shifts away from short-term emotional reactions and toward disciplined repetition of the process that generates long-term results. Consider the mindset of a professional penalty kicker in football. The player knows that not every shot will score, yet the focus remains on repeating the same technique with precision. The outcome of one kick does not define the player's skill. In trading, the principle is identical. The trader's responsibility is not to guarantee a winning trade, but to repeat the correct process with discipline and patience. At the end of each trading day, ask a simple question: was I disciplined? Avoid measuring the day by the amount of money won or lost. Financial outcomes fluctuate, but disciplined behavior is within your control. When discipline becomes the primary metric of success, the trader begins building a psychological foundation capable of sustaining consistent results over time. If you can trade for an entire week without breaking your plan, you are already strengthening your trading mind. Many traders underestimate the power of this achievement. Consistency begins with small victories over emotional impulses. Each week, the objective should remain simple: execute the plan without compromise. When this becomes habitual, the emotional chaos that dominates most traders begins to disappear. Visualization can also train the mind to tolerate uncertainty. Before trading, imagine entering a position that eventually becomes a losing trade. Allow yourself to feel the discomfort, then breathe slowly until the body returns to calm. This practice teaches the nervous system that a loss is not a threat. By rehearsing emotional stability in advance, the trader becomes less reactive when real losses occur. The market can be compared to the ocean. A trader cannot control the waves, the currents, or the storms. What can be controlled is the ability to navigate them. The professional trader learns to surf the movement of the market rather than resist it. Attempting to control the market creates frustration, while learning to move with its probabilities creates stability. When you approach the chart with fear of losing, your perception becomes distorted. When you approach it with attachment to profits, your judgment becomes biased. Only detachment allows clarity. The neutral mind observes the market without emotional pressure and acts according to predefined rules rather than temporary feelings. The mind that succeeds in trading is patient, balanced, and trained through repetition. This mental stability is not natural for most people. Human instinct seeks certainty and immediate reward. Trading requires the opposite. The trader must become comfortable with uncertainty and delayed outcomes, trusting that disciplined execution will eventually reveal the statistical edge. Great traders are not emotionally cold by nature. They have simply trained their responses. When fear appears, they do not react impulsively. They observe the emotion and return their attention to the plan. Their strength lies not in eliminating emotion, but in refusing to allow emotion to dictate decisions in the market. The professional trader does not attempt to control the market. Instead, the trader focuses on controlling personal behavior within the market environment. This distinction is critical. Price movement is unpredictable, but discipline, risk management, and execution remain entirely within the trader's influence. Mastery begins when attention shifts from the market to the mind, interacting with it. Every trade carries an uncertain outcome. No trader can determine whether the next position will win or lose. Accepting this reality liberates the mind from unnecessary tension. What remains under your control is the mental state you bring to each trade and the discipline with which you execute your strategy. This understanding represents the true foundation of trading mastery. The ordinary human mind seeks certainty, validation, and control. The professional trader abandons those expectations and replaces them with probabilistic thinking. By focusing on execution rather than prediction, the trader builds resilience and consistency in an environment defined by uncertainty. Many traders spend years searching for the perfect strategy while ignoring the mind responsible for executing it. Yet even the strongest strategy fails when discipline is absent. The true transformation in trading occurs when the trader stops searching externally and begins rebuilding the internal framework used to approach the market. The real shift happens when a trader decides that impulsive reactions will no longer guide decisions. From that moment forward, the objective becomes clarity, discipline, and repetition of a proven process. Charts, indicators, and patterns are tools, but the mind that uses them determines whether they produce chaos or consistent results. This journey is not about motivation or temporary inspiration. It is about developing a structured trading mindset rooted in probabilistic thinking. The trader who commits to this psychological training gradually replaces emotional reactions with calm execution. Over time, this disciplined mind becomes the greatest edge a trader can possess in the market.